Hello, everyone. My name is Pieter Dree, and welcome to this next episode of our PwC Tax Bites podcast. Today, we will talk about the new Belgian government and more specifically about the corporate tax, direct tax announcements in the government agreement. I'm joined today by my colleagues Michael van Genechten and Matthias Bastiaan, and with them, we're going to reflect a little bit and discuss also the measures announced in the government agreement and also what the impact can be for your business. Indeed, end of September, after almost 500 days, 7 political parties have reached an agreement on the formation of a new Belgian government. We call this the Vivaldi government. The objective is clear: relaunching Belgium. And at a time when the COVID pandemic is further spreading in Belgium, this is a very important message. There is an important package of relance plan on the table, almost 4.7 billion of euros. So very important measures to relaunch Belgium with social accents. And on the corporate tax side, there are also some elements in the agreement. I think important is that the large reform, corporate income tax reform of 2017, is not going to be revised. That is important. That was a positive reform, positive to support the Belgian economy and especially in these difficult times. But Michael, what is then on the table at this moment from a corporate tax perspective?
Hey Peter, quite a bunch actually. Some only covering one line in the coalition agreement budget. Firstly, it will come as no surprise that there's quite a bit of attention of the government to further support Belgian companies that have been heavily impacted by the current COVID-19 pandemic and to help them recover from this crisis. As such, on top of the earlier introduced carryback of tax losses, the government is also announcing the possibility to create a kind of reconstitution reserve to protect liquidity and solvency going forward. Second important batch of corporate income tax measures relate to how all this public expenditure will be funded. And we can basically distinguish measures that relate to the digital economy as well as the introduction of a minimum tax for businesses, where Belgium has voiced the ambition to going forward play a constructive role and even a front-runner role in the international debate, so at the level of the OECD and the EU. And also quite a huge amount of revenue is expected from the continuous fight against tax fraud. On the flip side, the tax amnesty procedure would be terminated by the end of 2023.
Okay, thank you, Michael. So quite some stuff on the table indeed of corporate tax measures. One interesting thing I heard was the reconstitution reserve. So after all, the reconstitution reserve would become reality, Matthias?
Certainly, and welcome to all listeners also from my side. So that reconstitution reserve, well, in a nutshell, it is a tax system that would be a temporary corporate tax measure and that allows Belgian companies to temporarily exempt part of their taxable profit. So what does it mean? Well, it means that Belgian companies that have incurred operating losses for financial year 2020, the so-called COVID year, can create a reconstitution reserve during financial year 2021, 22, and 23. That so-called reconstitution reserve is basically a tax-free reserve which decreases your tax due. Well, needless to say that this measure is also applicable to Belgian branches of foreign companies and not only to Belgian companies. So a lot of companies have suffered and are currently suffering from the COVID crisis. So the Belgian government wants a quick recovery of the Belgian economy. So the purpose of the reconstitution reserve is twofold. Firstly, it is aimed at increasing the liquidity of companies. Secondly, the purpose is to strengthen the equity of the company and hence to increase its solvency. Maybe I will give a very simple example to make it more tangible. Let's say that we have a company that realized losses in financial year 2020, operating losses. Well, as a result, the company's equity decreased and its cash position weakened. Assume that in the next year, in 2021, the company is profitable again, but it is still short in cash. So instead of paying taxes on the 21 profits, the profits can be temporarily exempt. This will strengthen both the cash position of the company and also its equity, because the equity of the company will not decrease with the tax cost. And in addition, in such a case, the company does not need to make tax prepayments. So this is very important from a cash management perspective.
Okay, yeah, thanks for that. So indeed, in times when cash is so important and businesses are likely to suffer not only this year but for many years to recover, I think this is a very important measure for all businesses that incur losses this year. This is, of course, a measure that, if I remember correctly, was already discussed in quite some detail over the summer. Does that mean that all the details are already very clear to us, Matthias?
Well, yes and no. You're fully right, Peter. So that there is a draft law that was pending already before the coalition agreement of end of September. In that draft law, there were a lot of conditions mentioned. It is not yet voted, but on the other hand, in the coalition agreement, it was mentioned that the purpose is that the conditions of those draft laws would be finally voted. So we have more or less a view on what the conditions will be. Well, in a nutshell, those conditions can be summarized as follows. So a company cannot benefit from this regime if it qualifies as a company in difficulties on 18 March 2020, or if it has shareholdings in tax havens, or if they made payments to tax havens. A company can also not benefit from the regime if it has distributed a dividend or another kind of reduction in equity, for example, a buyback of shares, as from 18 March 2020. That last condition, that no dividend can be distributed, and also conditions that with regard to tax havens, is also important with regard to other COVID support measures in terms of tax prepayments, for example, and the carryback system. Also, maximum amounts. There is an overall maximum amount of 20 million euro that can be exempt, and the amount is also limited to the amount of operational losses incurred in 2020. It is a temporary measure, so the reconstitution reserve becomes taxable if dividends are distributed or if the salary cost of the company decreases significantly, and ultimately upon the liquidation of the company. So my advice would be, if you want to benefit from that reconstitution reserve and improve your cash availability, it is recommended to closely monitor how the final law will look like and to see whether you meet all the conditions.
Okay, thanks, Matthias, for explaining these conditions. And I think the conditions on the not having distributed a dividend or a buyback of shares is very important. We receive a lot of questions from that from clients and companies that we work with. And yeah, apart from the extension of the investment incentive for SMEs, that's about it for the stimulus and for the positive measures. But then again, tax systems are also used to collect additional taxes often, and with the budgetary challenges ahead, I think this is not different today. Michael, what kind of measures can we already see in the government agreement that will bring additional funding for the government?
Well, firstly, Peter, there's reference to the digital tax and the minimum tax, which obviously refers to the work that the OECD is currently doing on Pillar 1 and Pillar 2, as well as the EU on the digital service tax, digital PE, and even CCTB. Um, as you know, there's quite some debate internationally on tax morality and the fairness of our global tax rules, in light of new digital business models that we've seen popping up over the last few decades, and to make sure that every company pays their fair share of tax, even in countries where they might not be physically present. And what Belgium or what the government is currently saying is that they fully support these initiatives, that they prefer that an international agreement is reached, but if not, that they would unilaterally vote for a digital tax, basically. What I found interesting is that the government already at this stage is taking a position that they do not only support it, but even want to take a front runner role in these discussions, in these initiatives, even without having performed any impact study, or at least not that I'm aware of. Um, as I would not be so surprised, given that Belgium is quite a small, open country with only 11 millions of inhabitants, that we would basically, yeah, suffer in respect of tax bases from these measures. On the other hand, it's clear that again, as in previous years or in previous budget agreements, the continuous fight against tax fraud remains one of the cornerstones. Um, and yeah, we have seen in practice that there are more and more audits going on. They're becoming more severe, more complex, not only in Belgium, but really this is a European tendency. And yeah, before it were unilateral tax audits, now they are bilateral, sometimes multilateral, sometimes even an audit is taking place within different legal entities of the same group at the same time. And data is also being used more and more efficiently. Yeah? Data is combined, and this will not yeah, change, or this will change, but it will only become more and more in light of DAC 6 for intermediaries, or the reporting requirement for intermediaries, and also DAC 7, the reporting requirement for digital platforms. Now, I do not believe that any one of us, including our listeners, has a problem with tackling tax fraud. On the other hand, we've seen in tax audits that there is a problem, or there's an issue that tax authorities are seeing tax fraud everywhere, even when there's no deliberate deception. And yeah, there is a clear pressure on public budget, and enforcement of compliance is important. But on the other hand, it's also important that the relation between taxpayers and tax authorities remains smooth, which is no longer the case anymore. The government now has announced a tax charter, including a code of conduct, with regard to mutual respect and professionalism between tax inspectors and taxpayers. And I guess here inspiration can be sought with our neighbors from the Netherlands with their horizontal supervision, for which there was already a pilot project here in Belgium under the umbrella of the cooperative tax compliance.
Okay, thanks, Michael. Yeah, two very important topics that you touched on. On the OECD pillars, I want to invite everyone to follow the podcast, because one of the next podcasts will go into more detail on this OECD initiative and what it will mean for European businesses and beyond, I would say. And secondly, yeah, the topic on what I would call the topic legal certainty, and the impact of fast changing tax rules in combination with indeed more strict and more detailed tax audit based on more detailed data and so on. That will also be a key challenge for business. Given this, we will spend a separate podcast also on this topic, on the future of legal certainty and taxation, where I will invite a number of colleagues who are working on different areas and aspects of this topic. So stay tuned, I would say. Before we conclude this podcast, Matthias, I wanted to ask you, there was also a mentioning about a contribution of the more wealthy people and the stronger shoulders, I think. What was in the government agreement on that?
Indeed, well, actually, not that much, but there was indeed a sentence in the government agreement where that states that the wealthiest people, so likely those with the strongest shoulders, need to do their fair contribution. But what this in practice will mean is not fully clear at all. So it may take the form of a kind of new securities tax or another kind of wealth tax. But I think it is a very sensitive matter in Belgium, any kind of wealth tax. And also, for example, from a legal perspective, the previous securities tax was annulled only in 2019 by the Constitutional Court. So it's a bit wait and see what this will bring.
Okay, thanks. Yeah, indeed, not all the details are known yet. I think that's clear from this discussion. Thank you, Michael and Matthias, for sharing your thoughts and having this discussion with me. I would say thank you also for listening in to the podcast. It's only our second podcast, so more will come. Stay tuned on the different platforms and our website for the next editions. I want to thank you all and hope to hear you again and speak with you again. Bye.